If you've spent the last few days, glued to the charts, you've seen what looks like just pure market panic, a really swift, chaotic drop.
Mm-hmm.
But here's the thing, the paradox.
Mm-hmm.
Right underneath all that frantic surface noise, there are these major institutional and regulatory breakthroughs happening almost silently.
That's exactly right. We're really looking at a moment where this acute macro fear, driven by things like Fed expectations, is clashing directly with these really fundamental, deep breakthroughs happening in the digital asset space.
Right.
So our goal today is to give you a complete, structured view of that conflict. We'll move from the biggest, most immediate shock right down to those quiet, long-term construction projects.
Okay, so let's unpack this starting at the top, the biggest headline. Bitcoin recently dropped below that really critical psychological level of $100,000.
And it wasn't just a regular dip.
No, not at all. This sharp collapse, it immediately kicked off what analysts are calling a liquidation cascade.
It was just startlingly fast. And the data, it shows you exactly how over-leveraged the market really was. We saw total liquidations hit, $463 million in just 24 hours.
That's a huge number. And the key takeaway from the sources.
Yeah, the crucial part is that the vast majority of that 342 million came from long positions.
From the bulls.
Exactly. So when we say liquidation cascade, we mean that rapid price drop forced exchanges to just sell off all these leveraged bullish positions, which then, it snowballs into more selling pressure and the price just falls faster.
That volume is staggering.
Yeah.
It really sounds like the bulls were caught completely off guard. But, the question is, what was the fuse here? Was this an internal crypto problem?
No, absolutely not. The drivers were distinctly macro.
Okay.
This was all about increased risk aversion across all global markets, specifically cooling expectations for any near-term interest rate cuts from the Fed.
Right.
The second the traditional finance picture gets a little dark, assets that are perceived as riskier, like crypto, they're always the first to suffer. It's just definitive proof of how tethered we are to TradFi now.
And you saw that pain transfer instantly to the secondary markets.
Yeah.
Ethereum and Solana, for example, they saw these pretty significant losses up to 6%.
Mm-hmm. And the institutional flow confirms it.
Yeah, the ETF outflows. We recorded about 278 million in outflow from the Bitcoin spot ETFs. So institutions were using those to de-risk and quickly.
And to give you a key analytical detail from the source material that might define a future battleground, JP Morgan analysts are projecting that the estimated production cost for BTC is sitting right around $94,000.
Okay, now hold on. I have to challenge that a little bit. Does knowing the production costs actually change an institutional investor's behavior? Or is it just a psychological line in the sand?
That's a fair question.
In a macro panic that's driven by the Fed, does the cost of electricity in Kazakhstan really matter more than the interest rate expectation in Washington?
That is a very fair critique. So while 94,000 might act as a technical floor because, miners will fight really hard to avoid selling below cost.
Sure, it cuts into their supply.
Right. But you're correct that in a widespread risk-off event, psychological factors, institutional outflows, those are almost always going to override those supply-side metrics. It's important context, but not a guaranteed support line.
Understood. Okay, let's move right to the spillover effect, because the panic, it didn't just stop at the spot market. It infected all the publicly traded crypto companies in the U.S.
And this secondary effect is just as important as the initial drop. It signals that global risk appetite is contracting, period. When BTC fell, the shares of every major U.S.-listed company with significant crypto exposure, especially the miners, they just took a severe hit.
We're talking about massive percentage drops here. Just to illustrate the severity for you tuning in, BitDeer, ticker BTDR, it dropped nearly 19%.
19.
Bitfarms, BITF, dropped around 13%. And then Cipher Mining, CIFR, and Iron, they both saw losses over 10%.
And what's particularly telling is the broader context. The tech-heavy NASDAQ fell 2%, the S&P 500 fell 1.3%, so even the mining companies that have successfully diversified a bit,
right, into AI infrastructure and data centers,
even they saw heavy losses. It just confirms that in a panic, their fundamental identity as a crypto-related company completely overrides their balance sheets. They are tied to Bitcoin's volatility.
So we've covered the fear, the financial contraction. Now let's pivot entirely. Let's look at a major demonstration of the long arm of the law. The shift from market chaos to real regulatory consequence. We have a powerful update from the UK.
This is a critical point that really links back to investor confidence. So, a Chinese fraudster in the UK was just sentenced to 11 years and 8 months for a years-long money laundering scheme.
And this wasn't some small-time operation. The scale of the seizure is what makes this a landmark case.
Absolutely.
The police seized 61,000 BTC. Get this. At the time of the seizure, that haul was valued at 6.3 billion British pounds.
It's a stunning amount. And the real implication here, it isn't just the sentence, it's the proof of concept.
Mina.
The investigation showed the immense effectiveness of modern blockchain analysis in tracing these organized crime proceeds. It provides hard evidence that supports the UK's zero-tolerance policy.
It sends a very loud message.
A very loud message. Digital assets are traceable. The anonymity criminals once assumed they had is it's rapidly disappearing.
That enforcement success, it confirms that regulators are paying close attention and, they're developing these powerful new tools. And that level of certainty is exactly what institutional players are looking for. So how are the infrastructure builders responding?
Well, they're building sophisticated bridges. Let's look at the Threshold network. They just announced a major upgrade to their TBTC bridge. And the key aim here is to more effectively connect institutional Bitcoin. We're talking massive funds holding BTC to the open world of decentralized finance, or DeFi.
So Threshold is basically building a secure digital train track.
Yeah.
They're allowing these massive Bitcoin holders to get into DeFi without needing to trust a single centralized company, which has always been one of the biggest bottlenecks, right?
Exactly. And the potential impact here, it's massive. Threshold is aiming to unlock up to $500 billion of institutional BTC liquidity for the DeFi space. That is a foundational step toward truly bridging that institutional gap.
And right on the heels of that kind of infrastructure build, we have a major institutional giant moving crypto right into mainstream payments. I'm talking about Jack Dorsey's Cash App.
This is a big one. Cash App announced major steps to enable both the Bitcoin Lightning Network and stablecoin payments on their platform.
So explain why that's so significant.
Well, the Lightning Network is a second-layer solution. It drastically reduces the cost and increases the speed of Bitcoin transactions. It makes it viable for, daily commerce, like buying a coffee, not just for storing value.
And Cash App has hundreds of millions of users globally. So this isn't some theoretical project. This is a huge, established player actively normalizing fast, cheap crypto payments for everyday life. That kind of integration makes crypto mainstream by default.
And if you needed any more proof that national financial bodies are shifting their perspective, look no further than the Czech Republic's central bank, the NBB. They just made their first ever purchase of Bitcoin.
Wow, a central bank.
A central bank, and specifically for a dedicated digital asset test portfolio.
That is a fundamental change in classification, isn't it?
Yeah.
It suggests that national institutions are starting to see Bitcoin not as some speculative novelty, but as a legitimate asset class.
For sure. It's worthy of consideration for reserve diversification and portfolio management testing. They're putting real resources into understanding how it works alongside traditional assets.
That suggests a long-term strategic shift that just completely transcends the short-term market chaos we started with.
Exactly.
Okay, pushing through the final set of priorities now. Let's talk real-world assets, RWA momentum. Ant Financial-backed R25 launched a yield-bearing RWA stablecoin protocol on Polygon.
This move really deepens the integration of traditional finance and DeFi. RWA tokenization is, to put it simply, it's converting familiar financial assets, in this case U.S. Treasuries, into digital tokens.
So you can use them inside the DeFi ecosystem.
Instantly. It creates a regulated familiar asset class that offers stable, reliable returns inside the volatile world of DeFi. It's like bringing safety rails to the Wild West.
Okay, moving from RWAs to altcoin demand, this next figure is genuinely surprising. Canary Spot XRP ETFs saw $58 million in first-day volume. Why is that so interesting?
Because it actually surpassed the launch volume of Bitwise's Solana ETF, which was considered a huge milestone itself.
Right.
So this is a very strong signal. It shows not only robust retail and institutional interest in XRP, probably because of its path toward regulatory clarity after that big legal battle, but it also signals this powerful, broad-based demand for altcoin ETFs beyond just Bitcoin and Ethereum.
Investors are actively looking for diversified exposure through regulated products.
For sure.
Okay, finishing out the institutional regulatory progress, we see the UK continuing its ambition to become a global hub.
Yes. ClearToken just received legal approval from UK regulators to establish a clearing system for crypto and tokenized assets.
And that's fundamental plumbing.
It is. Clearing systems are what ensure the security and settlement of high-volume trades. This regulatory green light for institutional crypto clearing, it provides the security and legal certainty that large funds absolutely demand. It's a huge part of the UK's strategy.
And finally, arguably the most historically significant item on the list, even if it's the smallest in market impact today, DAO regulation.
This is huge for the evolution of governance. Derivadex, which is a DAO-governed decentralized derivatives protocol, became the first DeFi protocol to receive an official license from the Bermuda Monetary Authority, the BMA.
Okay, so why is this license and why is Bermuda so significant here?
Well, Bermuda has really positioned itself as a progressive jurisdiction for digital assets. For a DAO, which is, an entity governed by code and community votes, to get a formal license from a national regulator, it means it now has legal personality. It has clear oversight.
That's a huge step.
It marks a crucial, if slow, convergence between these purely decentralized organizations and traditional regulatory frameworks. It paves the way for institutional capital to engage safely with true DeFi.
So we really covered the entire spectrum here. So a swift market disaster fueled by Fed uncertainty. And yet, at the exact same time, we saw a decentralized derivatives protocol governed by code finally secure a government license.
That is the core paradox you need to grasp from this.
Yeah.
In one single reporting cycle, we witnessed massive financial destruction and record-breaking criminal seizures, but simultaneously, the foundational structures for institutional adoption, secure bridges, central bank testing, licensed DAOs were being meticulously solidified.
The news cycle is absolutely bipolar. You have fear and traditional macro pressure just dominating the short-term price action, pushing everything down. But then you have regulatory certainty and technological progress dominating the long-term infrastructure being built right underneath the surface. You have to look past the price to see the trend.
And this raises a really important question for you, the listener, to mull over. Given the market's immediate dependence on the Fed's whims, that overriding market panic, and the Bermuda Monetary Authority licensing a DAO, that quiet but historic milestone, is the future of digital assets ultimately being shaped more by traditional monetary policy or by decentralized governance structures successfully adapting and seeking formal regulatory approval?
We'll let you chew on that one. Thanks for diving in with us.